A major country is collapsing. I'm your host, Steve Metre, and thanks for joining me today. And our lead story today, the unthinkable, has now happened. And I want you to see that it has dire consequences, not just for this country, but the entire global economy. Because there are certain countries that are big enough and integral enough in the global economy that if they trip and fall, well, they'll pull the rest of the world right down with them. And if you're wondering what I'm still doing in China today, well, it's simple. Things here are far worse than I thought. Let's over to Bloomberg, where we picked today's story up with a headline: China's trade plunges more than forecast and blow to their recovery. Now, it's not just China's recovery that we're concerned about, it's the global economy. Because you may remember back in 2015 and 2016, the global economy was cooling off. It was a first time we were seeing a synchronized downturn, and out of nowhere, China stimulated and pulled their country up and took everyone out of that slump with them. And you may remember yesterday we talked about exports. Well, today we're focused on what's going on inside of China, because things are falling apart and quickly. The deep slump in imports, this is a function of internal demand, is what we're seeing here. Is the drop was the worst since January. The overall consumption and investment growth probably both stayed quite weak in China. Now, this is a huge problem, because China was already slowing down to begin with. In fact, they were almost leading the rest of the world, if maybe with the exception of Germany and the rest of the Eurozone, who's rapidly slowing down as well. So as we look to internal Chinese demand, where consumers were believed to be sitting on a large amount of money and eager to spend it, what we're finding out is they're not spending money at all. China's economic recovery this year was expected to be buoyed by strong domestic demand, but a housing market slump has hit construction while consumption growth is slowing, a dangerous combination, as these issues are underlined by the fifth consecutive month of falling imports. And again, that's 5 months of declining internal demand. And so what we have a problem here is the entire real estate market. And you may remember when we covered this very deeply before, that China's real estate market is an effective Ponzi scheme. Unlike here in the US, where people take a mortgage on a completed home, in China, you take a mortgage out on a property that's yet to be built, meaning you're making payments before you've ever walked in the door or perhaps even seen your property. And what's the challenge here is these developers are chasing money. They need an influx of new loans so they can build the properties they've already promised. Challenge is they're running out of money, and what that means is China's entire housing market could come crashing down. That Ponzi scheme could outright blow up at a time when the global economy is looking for some sort of savior here. And if China's property market breaks and crashes, well, it'll have systemic issues to the entire global banking system and economy. And then that takes us now to the threat of deflation is starting to grow as companies in China are starting to cut their prices to survive. Now, this is hardly unthinkable in itself, because we keep hearing that inflation is not only going to continue to rise, but it's going to resurge in a major way. And if not for central bankers' steady hands on the economy and monetary policy to bring inflation down, that we could actually maybe even face periods of just outright hyperinflation. But in China, look at this exact opposite is happening here. And what I want you to understand is imports. The lack of demand is translating into businesses cutting their prices, because really consumer prices are more about supply and demand than the actual price itself. Instead of rapid-fire price gains predicted by some economists at the beginning of the year, China is experiencing a rare period of falling prices. Now, keep in mind, this is a dangerous problem in a debt-based economy. You do not want to see prices decline. Maybe you're okay with them staying flat for a period, but over time you need to see prices rise. Deflation, you may recall, we've heard central bankers say this. They can deal with inflation. They've got the tools for it. But what keeps them up at night is deflation. And that's a clear contrast to the rocketing inflation that's followed the reopening of the U.S. and other major economies. Even though many people don't believe that we could see deflation here, it's in the cards and is visible in China at both the factory gate and the retail side. Producer prices have been contracting on a year-over-year basis since October 2022, largely due to falling prices for commodities like coal and crude oil. And so what we've seen and we've shown in the past is that where Chinese producer prices go, U.S. consumer prices follow, and that is a dangerous game because if you remember here, China exports deflation, the U.S. exports inflation. Now, how do we do that? Well, we export dollars. How does China do it? Well, think about the last time you went shopping and bought something made in China. If prices there are deflating, well, that means eventually they're going to start deflating here in America. And using the gross domestic product deflator, a measure of economy-wide prices, China's already in deflation. The International Monetary Fund defines deflation as a sustained decline in or an aggregate measure of prices, such as a consumer price index or the GDP deflator, such now that if we start to see China's CPI go negative, well, it confirms they're in a deflationary spiral, or at least the beginning stages of it. And if they're starting to deflate, well, as I said, they export deflation. It just tells you what's coming for the rest of the world at a time when you look at what the Fed is doing and their policy have maximized and have driven rates up at a time when they should be cutting rates, because we're starting to see the early parts of deflation out of China that will eventually hit U.S. shores. And if prices keep dropping across a broad range of goods for an extended period, consumers could delay their purchases. So again, this has serious problems for the economy, particularly in the future. It can curb economic activity further and force businesses to keep reducing prices. That in turn would cut into revenue and profits, prompting firms to curb investment in jobs. That's the key thing there, is jobs, because what happens during deflation, if prices are going down of what your selling price of your product is, but meanwhile your other prices, such as say your rent, your utilities, your insurance, the cost of employees, if that's not deflating, and generally they don't, but you're getting less for your product that you're selling, well, there's one thing you can do to control issues, and that's lay people off, which is why deflation is such a nightmare scenario for central bankers. And that results in the kind of economic stagnation that Japan has suffered for decades, and that would be frightening if it comes to China and the rest of the world. But don't talk about deflation here, as I'm probably going to get kicked out of the country tonight and had to have somewhere else, because talking about deflation publicly is also off bounds for many Chinese analysts. One economist at a local broker said he was instructed by regulators not to discuss inflation. He was told to promote the narrative that China's economy is steadily improving, he said, declining to be identified in order to discuss private information. Another China-based economist said they received guidance from regulators and their company's public relations department not to discuss deflation publicly, because this is literally the unthinkable that is happening, my friends, because we're not supposed to see this. All of these central bank policies, all of these government policies should lead to a steady increase in inflation, and what we're seeing is this overconsumption from the pandemic is leading to global disinflation and how the beginnings of deflation in China. And notably, nobody is going to do anything about it until it's too late. And the ramifications are serious. A big driver of low prices this year is the buildup of inventories over the pandemic and in the first quarter during a burst of optimism following the end of COVID restrictions. That has since reversed, with businesses getting this, cutting prices to reduce their stock. And this is a major problem, because if we look here in the U.S., we have the same issue. It's not just China that built up their inventories. They built up their inventories because we wanted stuff. And so wholesalers here built up inventories. Retailers have built up inventories, and yet the common belief is among the Fed, among consumers, is that inflation is going to rear its ugly head again. But look at this chart here. We've got retailer inventories in red, showing you that on a year-over-year rate of change, which are near all-time highs, by the way, against consumer price index. That's shown in blue. And what do you see where retailer inventories are going? This consumer price index is just a proxy of supply and demand. So as demand goes down and retailers need to clear their inventories out, they will start cutting their prices, causing a feedback loop that will lead to lower prices, further disinflation, and perhaps outright deflation. And yet, what we see now today, China slips into inflation in warning sign, and this is not just for the Chinese economy, but as you can see, it's a warning for the world economy, as I've been saying. But one thing that shouldn't be slipping into deflation, well, that's your trading account, because if you had CTA-Timer Pro, well, you'd be inflating quite a bit. Let's go back to our soybean trade, because subscribers are starting to look at this and saying there may be another setup for a move higher. Keep in mind, twice a week on Wednesdays and Saturdays, we put out a list for subscribers to help them identify potential trade targets on the system. And here we can see, looking back, this is when our system, when CTA-Timer Pro, that looks at the computer models, runs a historical overlay, said this is when you should start taking position. And this candlestick right here is when it says you should probably sell out of those positions. That would have been a 10.7% gain for your trading account in two months. And here you can see the first signal on June 9th, signaling short covering by the machines from a very deep minus 100% short position. What we look for to see a reversal, and then we see it here on August 2nd. The machines are selling down, giving you the signal to get out and capitalize on that trade. What we see right now is there's going to be a major setup in one of those signals. The only way you got to see it is to subscribe. It's $30 a month and comes with a 30-day money-back guarantee. Check it out, because the world economy is slowing, well, and your trading shouldn't be. As tepid consumer demand and rising economic concerns in the world's second largest economy have tipped China into deflationary territory for the first time now in 2 years, adding pressure on Beijing to act more aggressively to avoid a deepening economic beliefs. And one of the challenges here is that if you keep stimulating an economy, there's a point where monetary policy and fiscal policy do not have the multipliers, and they do not have the effects that they used to have. And after all we've done during the pandemic, further actual stimulus may actually not do anything but just burn a deep hole in, of course, these fiscal pockets of these governments. Instead of experiencing a surge in prices after lifting of COVID-19 pandemic curbs last year, China is suffering an unusual bout of falling prices for a range of goods, and not just commodities like steel and coal, but to daily essentials and consumer products such as vegetables and home appliances. And their predicament stands in contrast to that to the U.S. and other developed Western economies, at least for now, where soaring inflation after lifting the COVID restrictions sent central banks, including the Fed, on an aggressive path of interest rate increases aimed at cooling the economy without triggering a recession. And that's kind of the challenge here, is because if indeed what we're seeing in China is real, and this is the very first step of perhaps more months of deflation hitting there, well, that tells you that central bankers like the Fed are completely wrong about monetary policy, that they've raised rates, that they've tightened lending conditions, they've inverted the yield curve, which is exactly what's predicted this. Now, you remember, we talk about money curves on this show, and we show you the data that says, look, deflation is coming. The curves are saying it. Well, you're seeing it happen in China, where curves there were indeed inverted. And what this is telling us, that the Fed, who keeps talking rates up, keeps talking about this resurgence in inflation, is going to be chasing deflation, likely before the end of the year. And here you can see why, of course, China is so critical to the global economy, and that if they trip and go down, the rest of the world goes with them. Because here we're looking at the U.S. Consumer Price Index, again shown in blue, which we will have an update on tomorrow. and we see then U.S. imports of goods by customs basis from China in red. And you can see that as, of course, imports from China goes down in red, what does that tell us about demand from U.S. consumers? That it's declining. What does that eventually mean for prices at a time, again, when retailer inventories are not at all-time highs, but they're pretty darn close to it. And here you can see imports are crumbling down, and they're going to further decline until all of this inventory is worked down to a level that wholesalers and retailers are comfortable with, which could mean a lot of big markdowns at a time when U.S. consumers just aren't looking to spend, and then those that perhaps are facing a big problem because the student loan repayments are coming back starting in October. And here we can see it also matters because not only as imports fall, as we mentioned, we see in China prices are getting cut. Well, it's going to same thing is happening to those import prices from China. Is they're contracting now, saying they're going down, and that means that U.S. consumer prices are indeed going to follow, because where Chinese import prices go, U.S. consumer prices follow, and this is big problems, of course, for the U.S. economy, because you might say on one hand, hey, well, that's great news. That means my dollar might go a little further. Well, there's a problem with that. Check it out. While falling prices in China may help ease inflationary pressure elsewhere, as Chinese exports become cheaper, they could become the source of another concern for the global economy. For instance, a flood of low-priced Chinese goods, remember, this is exporting deflation, risk squeezing profits for producers in other countries and hurting employment opportunities. That is a fancy way of saying that China will start undercutting U.S. and other foreign manufacturers who cannot cut their prices because they just gave out a whole bunch of big raises, because they're also assuming not only they have to deal with inflation, but the economy is going to boom. And again, putting a situation where China's exporting deflation and it's going to end up leading to more layoffs in the U.S. at a time when policymakers keep saying that the worst of the layoff round is behind us, and I think we're just beginning of where that can go. Chinese consumer prices fell 0.3% in July compared with that from a year ago. And of course, that shows at a time where the U.S. consumer prices rose 3%. But again, we'll get that new data as of starting tomorrow. The reality looks increasingly grim. We see this from a professor of trade and policy and economics at Cornell, the former head of the International Monetary Fund's China division. The government's approach of downplaying the risk of deflation and stalling growth could backfire and make it even harder to pull the economy out of a downward spiral. And there is a lot of truth to that, because once deflation takes hold in an economy, it sort of just pulls everything down and continues to pull it down, forcing governments to cut interest rates and stimulate. And can you imagine? Here we're going to go from all of this, higher interest rate mantra in the U.S. to perhaps the Fed being back at zero, doing quantitative easing, which they said they wouldn't do again or unlikely to do again, and the government maybe even getting back in the fiscal stimulus game before we are actually spiraling down with China into a deflationary mess. And here you can see the effects of that in China's real estate market, as Country Garden is in danger of a default rivaling Evergrande. Now remember that Ponzi scheme we talked about of the Chinese real estate market. Well, remember, if internal consumption in there slows down and stops and people stop buying real estate, well, the problem is the property developers don't have an influx of new money to finish the properties they already committed to, and that is a challenge, meaning the whole system there could go bust. And Country Garden Holdings, helmed by one of China's richest women, has left investors in the dark after dollar bondholders, those are U.S. dollar bondholders, said they've yet to receive coupon payments effectively due on Monday. That puts the firm, which has about 199 U.S. billion of total liabilities at the end of last year, on course for its first public default if it doesn't make the payments within its 30-day grace period. Any default would impact China's housing market. Well, it would impact their entire economy more than Evergrande's collapse, as Country Garden has 4 times as many projects. Any debt crisis at Country Garden will have a far-reaching impact on China's housing market sentiment and could significantly weaken buyer confidence on solvent private developers. Well, imagine the global banking system at this point if you start to see the entire Chinese real estate market starts to crumble down, property developers start to default. It's going to cause banks to even tighten lending standards more and start to raise capital against a surge of defaults. The whole system is going to start to crack and come falling apart. Home sales in China are falling again. Well, no surprise, internal demand's going away. Dashing hopes that policy steps to prop up the industry would spur a lasting rebound, and with creditors demanding prohibitively high yields to lend more money, even Country Garden was forced to say this week that the refinancing situation has crippled its cash flow, and that's not just China, it's spreading elsewhere. Look at this headline as disinflation spreads in emerging markets as sell-off deepens. And so what we're seeing, again, as I said with the beginning of the show, is what starts in China. It's kind of just starts to spread to the rest of the world. So now we're already seeing some early signs of it getting out into some emerging market countries. Tomorrow, we're going to see the CPI here that's going to probably likely show further disinflation, putting pressure on the Fed to pause rates and maybe even aggressively cut them by the end of the year, as the money curves have suggested. And it's amazing that the yield curves, those inverted yield curves that the Fed and other experts are completely ignoring, have predicted all of this, because remember, where China goes will eventually follow. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.